Welcome to C Squared Biz Growth Iron Sharpens Iron podcast, where CEOs and entrepreneurs share how they are overcoming business growth and sustainability challenges.
I am your host, John Hale III, and we are excited to have and honored to have as our guest, Eric D. Collins. Eric is the CEO and founding member of Impact X Capital Partners, author of We Don't Need Permission, and host of Channel 4's Moneymakers. Eric, how are you doing today?
I'm good, John. Very good. You're well?
Yes, very well. Thank you for joining us. We want to jump right into conversation. So we see how you're showing up today as a real successful CEO. You've raised your own money as a VC fund. Can you share with us what from your early career or childhood really had the most impact on who we see today?
Yeah. Well, I believe that success is never a terminus point. It's not as if, well, with me, it hasn't been. The idea that you've gotten to a certain activity or a certain sort of marker, and then that has led to you saying, my work here is done, and there's not much more to do. So in terms of what has probably led to that belief is probably the most interesting bit, because I come from, and I don't know about you, John, but I come from a Southern family. So a family that was, built in the cauldron and sort of tested in the cauldron of the American South before, during, and then after the Civil Rights Movement. So well before the Civil War, even in some ways before the American Revolution, the Black Collins family, the African American Collins family, has been in the American South. And so if you're going to and stake your claim in the South, where you're an enslaved group of people, you're a freed but marginalized group of people, you're a Jim Crow'd group of people, you are a bused group of people, you are a voting rights group of people, you are a, whatever it is, a Dixiecrat group of people, you've got to say to yourself that there has to be more than what we currently have done. And you are always looking for ways in which you can improve for the future, because the perception is that there is a future which is going to exist. And that future, although I might not be there for the ride, is going to involve people more talented, more able, more willing than me. And we should make the world a better place for them. So for me, it has been following in the footsteps of my grandparents and great-grandparents, but particularly my parents, who actively put themselves on the line in order to make sure that change was going to come, but not just for them, not just for their children, but for the communities that they felt were important. And so they invested time and energy. And so for me, the idea of starting a venture capital firm and then investing in other people, the idea of being an executive in fast growth technology companies and hiring somewhat in a differentiated fashion, people that other people weren't necessarily looking at, and utilizing that and riding the wave of their talents to great success for the companies. All of those things are sort of building on that same kind of Collins ethos, that when in the cauldron, and the cauldron will continue, even though if the fire feels a little bit lesser today than it might have the day before, but you still have to make sure that you're in the fighting space and in your fighting mode. So that would be, although not exactly a story, it sort of gives you the ethos. It gives you sort of the set of shared values and sort of family-oriented values that have been going on for generations from where I come from. Again, and I think a lot of that has to do with being from the American South.
Right. So it's really part of your DNA.
I would say it is part of my DNA. Are you from the American South? Do you have any Southern family?
Oh, yeah. Mm-hmm.
Okay.
West Virginia and Oklahoma, Tulsa to be exact. Yes.
Oh. So you're right there in the mix of things. So that to me, I mean, your family probably has a similar sort of an approach and a similar sort of a view of the world, that there is work to be done, constant work to be done. And we can't rest at any particular point. You might be able to enjoy things and take a little bit of a respite, but you need to get back in the game, and you need to get back in the fight, really.
Yeah, it's all about enjoying the journey, but part of those values clearly are with family, and then it's also with who else are you going to bring along with you? Your success is a group success. It's bringing others along with you.
And don't you feel, John, that that then, as a CEO of an organization, as a founder of an organization, as someone who might be a manager in a company, if you could bring that with you, that it's not about personal aggrandizement only. I mean, yeah, congratulations. We all have egos, and that ego leads us to want to achieve and to be recognized for those achievements. But if part of what you're doing, as you said in your DNA, part of it, your ethos, part of your values is that the way that I am actually going to be able to be fulfilled and the way I define success is by group success more than just individual success, more than even just family success. That then leads to, I think, a set of choices that you make. And those choices can be career choices, they can be family choices, they can be living choices, a bunch of different choices. And I think it influences how how those choices are made and the ultimate result of those decisions and choices.
And then to me, it kind of leads to this idea of you being a VC venture capital. You are literally investing in others. You're taking others' monies to invest in others. And the people that you're raising money from, you've convinced them that you and your team are the people to invest with, that you'll get a great return on the money. But then you're investing in other people's companies, and particularly at the VC level of nascent, forming, developing companies, you're investing just as much in the people as in the companies that, as you pour into them, money, information, strategy, etc., that they're actually going to grow.
You know, those people, John, are actually an extension, an interesting extension that I didn't even realize before I started. It's an extension of the same kind of value system. We're putting money on people we didn't know before. I didn't know it's not as though I grew up with these people. It's not as though these people lived in my community. It's not as though I'd heard of these people. These are individuals who have ideas and disruptive ideas as to how the world can be a better place. So for instance, we take a company like Marshmallow. Marshmallow is an insurtech company here in the UK. It is an organization whose ethos is that if we can help migrants to get better insurance rates for their automotives than they could otherwise. And these are people who are coming in. This is sort of the case, these are the sort of people that in the United States and the UK, there's a bunch of contention around their ability to be in the country. But they say these migrants actually are a very important part of the economy. And what we do is that we have a way of connecting the driving record from their place of origin with their application as they're in the UK looking for insurance. And what we're going to do is make it so that instead of paying 5 times what someone who's domestically born, raised, and has driven and has a driving record here pays an insurance premium, we'll get them the same kind of rate. They have been able to do this and have been able to raise uh, over $100 million. They have a valuation that is over 2 billion, and they have been able to grow with women and people of color in key roles. So women are 50% of their workforce. This is a fast growth technology company, and that never happens, especially one that's not female founded. And that 20% of their people are people of color, and particularly Black Britons. Here's an organization that we, by being venture capitalists and putting money behind them, are able to extend that vision, which is maybe a Collins ethos and value, but outside of the United States, outside of our community, and to be building something which ultimately we believe leads to a bunch of things like, the PayPal mafia. You've heard of the PayPal mafia.
Yes, definitely.
We intend for there to be a Marshmallow Mafia, a group of women and men who lead that organization and incubate other consequential organizations and take their experience and pedigree, and they change the world. And that for us, that for me in particular, is one of the values of being a venture capitalist, which I did not truly appreciate. I had been part of the venture capital scene for a while because I've been running companies that were venture backed. So I've been raising money, but then raising my own to run my own company or a company that I was running on behalf of someone else. But to raise money, have that pool of capital, that blind pool of capital, use it to invest in others, and then be able to use that very strong position to be able to then have the downstream impacts and probably intergenerational impacts that we intend. Now that is consequential, and that's amplification and acceleration of the change world that we're looking for.
Gotcha. Well, thank you for sharing that. It's very powerful. And let's take a step back a minute. So when you founded the company, Impact X Capital Partners. Can you just tell the audience what you guys do, who you are, what challenges that you solve for your clients?
And let me tell you, this has been a struggle, and this hasn't been the easiest point in my life. ImpactX is a double bottom line venture capital company, meaning that we have two missions. One is, and the most important one, and it permeates everything that we do, is that we are looking for differentiated deal flow that is going to return uh, capital at a huge multiple to the limited partners who put money behind us as a fund manager. So we intend to be able to deliver at venture time, which means fairly quickly, and in venture scale, that means very large, the
Mhm.
amount of money that they put behind us.
Okay.
But in addition, we intend for the money that we actually are investing and returning to be catalytic. And one of those catalysts that we measure on our own is that the companies that we're backing as fast growth companies are actually creating jobs. And we are interested in the jobs that they are creating, not at the entry level in an apprenticeship program or an internship. We are interested in the board of directors. We're interested in the founders. We're interested in the C-suite. We're interested in P&L responsible organizations. And we are interested in a technology driven world in who is sitting in technology seats and helping to make decisions. So our double bottom line is to find the return that is so fantastic that people who don't have the same kind of values as we do want to put money behind us. And that the great thing that they get from putting money behind us is not only the return, but then they also have these social impacts. That's what we do. We started in 2018. What was happening in 2018? It was well before George Floyd. It was during, I think, the first Trump administration. It's after the Obama administration. There are, winds of change are blowing hard. But we're here in the UK. We were headquartered and started in the UK. So we're not in the United States. We're somewhere else, but we're in the midst of Brexit. There are a bunch of dynamics that are happening. We're getting ready to be in a world of rampant, just galloping inflation, cost of living crisis. A lot of things are happening. COVID's right around the corner. None of that was when we started, but that's what was going to happen. So we put ourselves into the space of raising a fund because we felt that it was a good time, and that if we didn't raise this fund, and I say we because the way this all got started was because someone who's a very famous comedian, actor, and philanthropist from the UK said, we got to do better here because 1 in 2 Black children in the UK are living below the poverty line. This
Mm.
is 2018. We got to do better. What should we do? And from there, a conversation started. But that conversation didn't take quarters. It didn't take decades. It took weeks. And we came to the conclusion a venture capital firm makes sense. And that's how ImpactX got started. And Lenny Henry is that comedian I'm talking about, who in the UK is a national treasure. In the United States is known somewhat because of his work in The Witcher and his work in the prequel to The Lord of the Rings on Apple TV. But he's known here because he's been a star. Like he won Britain's Got Talent when he was 16. And that was decades ago. And he has been at the top of his game ever since. So he helped to start this organization. He helped to say, it's time that we stopped talking. It's time that we started doing.
Thank you for this sharing, the expansive view, particularly of the double bottom line. We don't hear about that often in the VC space, but thank you for sharing that. Are there certain industries that you invest in? We know that from a VC standpoint, you have to have superior returns very quickly, but do you have an industry focus at all?
Oh, absolutely. When we started back in 2018, we also did a study to see what were the areas where there were pockets of talent. What were the industrial sectors or the investment sectors where there were pools of talent and deep pools of talent who had experience and generally were differentiated in terms of who the founders could be with that sort of experience, meaning that they were not sort of the typical person that might be the search image of most venture capitalists, particularly out of Silicon Valley or maybe out of Beijing or out of Delhi. So what we found was, having studied many countries in the European Union as well as the UK, that if you look at underrepresented people, they are really found highly concentrated in digital and technology, lots of people in that space, health, education, and well-being, lots of people in that space, and media and entertainment. The The secret about venture capital is it's all about your deal flow. How many deals and how good are the deals that you actually get to see? And then how do you get yourself into these deals so you can then ride the wave of their ascension or their ultimate demise to the returns that you need for your LPs. So once we did that research in 2018, we found those three different sectors: digital technology, health, education, well-being, and then media and entertainment. Those were the three areas that we found that there were those concentrations. And we persuaded people that if we invest with those into those categories and we invest for differentiated deal flow, meaning we're looking at women, people of color, people with disabilities, LGBTQ plus, a bunch of different criteria, that we would be able to find outstanding and extraordinary entrepreneurs who could return. And based on us investing, we could be an institutional investor, but we also would be people who would not be sort of dealing with some of the froth in the market that you saw, before 2020. Just in general, there's a lot of huge, sort of valuations that existed, mostly not for women, people of color, people with disabilities, and those sorts of things. And then now you see that same sort of froth in artificial intelligence, for instance. You see it every day, or in crypto. But it's fine. So we have made ourselves very, very clear that that's what we're going to invest. And we have been investing with that thesis and been able to find, we have about 10,000 companies that we've been able to source around Europe and the UK. We've made, out of 10,000, we've only made 50 investments though. So that is a very, very steep funnel that becomes highly concentrated on trying to find companies with the right dynamics. The only other thing that I would mention is that impact, there are a lot of people, let's say people of color. If you say, here's a person of color, and we're talking about Black people, I believe that most people in the world would say that there is a very high correlation between Black and creativity, whether that is for prejudice reasons, or sort of these negative prejudgments, or positive prejudgment. There's generally some acknowledgement that those two things go well together. And that if we're talking about real leadership in a field, creative fields would be a place where you would say that having people of color and women involved leads to being on the cutting edge. So, but many organizations really who are venture capitalists don't invest in that category. So cutting out all of the opportunity there, because it doesn't look the same as starting a company like Netflix. Netflix is a media company, that's for sure. So it's in media and entertainment, but it's really a technology company. How do you make sure that you can have millions of people simultaneously, watching something with no interruption over a variety of channels, in a variety of networks and other sorts of things in, various corners of the world, and to be able to create new content that creates a desire for people to continue coming back? That's what Netflix did. But people kind of understand that. When you say what we want to invest in is we want to invest in an animated series about a young Black girl from Europaland who comes out of her amnesia and then is helping to save the world with the help of her group of friends and the animals who have been weaponized against her, but she converts them and then they become part of this sort of troupe that helps to change Yorubaland. That is not something that most organizations would be funding. They'd be thinking instead, I want to get to the NVIDIA. We've said, look, we have got to find a way to invest in some of those projects, and we have been able to do that. And in fact, the story that I just told you is a story which is the #1 cartoon on Cartoon Network in the United States, as well as HBO Max. It's called IYANU, Child of Wonder, and it is in our portfolio, our venture capital portfolio. And this is not sort of a carve out that we have for creative. Our creative projects are working and competing for the same capital as the company that we think is going to be the next, that's going to be the next Calendly. That is what we are constantly seeking. And we have found that there's a way of investing in creative projects that has the same attributes, both in terms of milestone-based investing, early stage investing and taking on a lot of risk, taking a relatively significant portion of a deal based on that, and then being able within 3 to 5 years, see a significant uplift in terms of the valuation and be able to monetize that uplift by returns that then get distributed to our limited partners. And that's the goal. And if it hadn't been for Roy Akupe, who is American Nigerian living in Maryland, and his unique universe, of which IYANU is just one of a small fraction of all the creativity that has gone into his graphic novels, that is exactly what we seek to do. But many organizations would say, wow, that's just too speculative. And I think part of that is speculation based on, this is something that most venture capitalists don't invest in, hasn't been a traditional venture capital category. But then also the people who are generally doing well in this area are generally not considered the kinds of folks that other venture capitalists would back. But we love differentiation. We think that is exactly what started venture, and that is what we lean into.
It seems like you're really going back to the true nature of venture capital. And thanks for sharing with our audience as well, just the distinctive strategy you use when starting the fund, what you're looking for, gaps analysis in the market. How much money did you raise there with your first fund? And I guess can you describe how many portfolio companies do you have?
We raised less than 50 million. We were pretty deliberate that when you start a fund, you've got to think to yourself, you have a new strategy that no one else in Europe is really using. So you're saying that you're going to invest in these women and people of color, digital technology, health, education, well-being, and media and entertainment, and you're going to be able to return 3 to 5 times what people put in 5 to 10 years. That's what you're saying you're going to do. So given that we didn't have as much exposure as we might have liked to the results of investing in those sorts of deals, we had to do something that was a pilot. So we piloted with a small fund, and this fund was funded by people in the US on both sides of the country, both on the East Coast and the West Coast, UK people, and then French people. That is who high net worth individuals who had a high appetite for risk, those are who backed us. And they were all Black people. That was our first fund. And our first fund was very, very small. Our first one was less than 5 million. So, but we were able with that fund to show Marshmallow, which I described, and IYANU, which I just described, are both in that portfolio. That portfolio has returned at excess of what would be anticipated for venture. And so that one's a very successful fund, on the heels of which we were able to then raise a second fund. But in the second fund, we also said to ourselves, let's, take a real big swing, but let's also be clear, because we want to bring in corporations. We want to bring in institutional investors and asset allocators, which we did. So we have the Visa Foundation. So we have endowments. We have the Guys and St. Thomas's Foundation, which is one of the biggest and oldest endowments here in the UK. We've got family offices. We've got a fund of funds on the West Coast of the United States in Silicon Valley. So we have been able to, because of the reputation and track record we built in our first fund, to attract interesting institutional tier one investors for our second fund, which then is being deployed even as we speak. And then once we have a bit more track record with that one, we'll go out and raise another fund, which will be larger. Constantly a series of it's like Russian dolls, or these nesting dolls, one after the other, that you put together to help to build both your reputation and track record, but then also to build momentum in terms of the category.
Thank you for sharing that. So it seems like you leaned on that technology background in terms of the first fund. I don't want to call it a pilot, but something smaller. You show the success, you just accelerate the growth thereafter.
Correct. And that it's a very the other thing that we wanted to do, John, is we wanted to make sure the team around the table, and the team is a fascinating team, I should describe them to you, but we wanted to make sure that what we were doing also was something that was relatively transparent in terms of the manner in which we fundraise and deployed capital and made our investment decisions generally, because we hope that we can serve as a pilot for other organizations. We believe that there are other fund managers who are similarly situated who should be out in the market and getting their start in the way that we did, that they should be getting a cohort of people who are, ethically and values-based sort of tied to what they're doing, and they should use that to prove and really return capital, do all the things that you need to as a venture capital fund, and then from there, start raising institutional capital. Make sure you have a very strong reputation and narrative to raise on, and then go raise from. As opposed to raising speculatively, this is what I want to do. You can raise based on track record. This is what I have done. And so many of us are in the position where we have not necessarily raised before, and therefore going out and raising with, I hope to be able to do this, is not as powerful as I have done this. And the way that you can get it done is, putting your buckets, using that expression that, I most identify with Booker T. Washington, but is actually a biblical story about throw down your buckets where they are. And in throwing down your buckets where they are, because you think that you're in a place where there's only salt water, there's actually fresh water. So throw down your buckets where you are, and you will be very pleased with what you pull in. And so we have found that to be the case also within our own networks and the like, being able to throw down those buckets.
Thank you for sharing. That's very powerful use of that metaphor. You've talked about it from the fund standpoint. Now I want to talk about a little bit from the CEO standpoint of some of these enterprises that are looking to get venture funding. United States, the Angel Capital Association recently put out a statement, some information that, funding for VCs that receive funding is 0.05% in the US, kind of 0.5%. And is that similar in the UK? And how can CEOs increase their odds of being funded by a VC?
And those numbers are for the general population. Is that number for the general population? Though that's not for Black founders or women.
Correct. That's general population.
In the UK, we actually underwrote a study with an organization called Extend Ventures. And Extend Ventures is run by three fantastic folk. One is Patricia Hamzahi, who's an American who lives here in the UK, and Erica Brodnock, who just received her PhD, who is a researcher who's British, and then Tom. I think Tom's last name is Adiola. And these are some people who've decided that what we need to do is we need to apply a rigorous approach to research in order to be able to prove things. So in the United States, for instance, there's Jennifer Eberhardt and Darren Dobson, who have published, and Jennifer, who is a social psychologist out of Stanford, who now teaches, I think, at the business school. They have put out studies about bias in asset allocators' behaviors related to allocating capital to fund managers. And we try to then replicate some of that here in the UK in talking about how is the allocation for not asset allocators, generally, institutional asset allocators to fund managers, but how asset allocators, fund managers, are investing in entrepreneurs. What we found is that less than 2% of venture capital pounds and pence go to women-led ventures, meaning that, if there are two women who started a company and there's no man who's part of that sort of group, those two women only receive 2% of venture capital funding. If you're looking at people of color and put that into the mix, and you say that there are, say, Black people, then 0.02%. So, 0.02% is not 2%. That's much less. And then if you put Black women as founders of companies, and there are Black women who have founded this company, either solo founder or a team of Black women, 0.006% go to those women. The study was done in 2020, was completed in 2020, and we're looking to renew that study to see whether the dynamics have changed tremendously. We anticipate that they haven't. Just this is based on qualitative. The first is quantitative research, but the follow-on would be from my qualitative assessment based on sort of what we see getting announced. Those numbers haven't changed tremendously. So that's the number. The numbers are quite miserable. And if you think about this, John, what we're saying is that the number of the amount of money which is going to really disruptive ideas and disruptive spaces is relatively small when intersected, with the question of gender and race in Europe and the UK and in the United States also. And that's a big challenge. The interesting thing, though, John, is I think that that was something that was absolutely devastating a few years ago. I'm trying to figure out, my team is very interested in what is the impact of artificial intelligence in terms of reducing the cost of founding. So if what we're saying is that no longer do you need as an entrepreneur, you might still need as an entrepreneur. I mean, but say you don't now need as much reliance, you don't have to give as much reliance to the engineering portion of your solution. And that indeed, using natural language, you're able to actually produce software that does what it is that you'd like to do. And maybe instead of having to have someone with you for hundreds of hours or thousands of hours, or even millions of lines of code, suddenly you're able to reduce that cost tremendously. And you're able to get to an MVP, if not to a scalable model, with very little reliance upon having someone that you either pay as an outsourced organization or bringing someone onto your team as a full-fledged founding person. Does that actually mean that what we're going to find is a huge increase in the number of entrepreneurs who are able to produce interesting solutions to consequential problems, and that women and people of color will see a higher participation rate because the cost of participation go down? You don't need an institutional investor like ImpactX anymore so early on. You can wait until, in some of these companies, we're hearing stories now that companies who were invented last week have hundreds of thousands in revenue within a month. It's you've built what it is that you're building, you've put it in the market, you've actually been able to generate hundreds of thousands in revenue. And so you really don't need the same kind of capital. Some people estimate that you now will have a quarter of the kind of employees that you might otherwise have, even if you were starting 2 or 3 years ago. That is a huge efficiency. And how that affects underrepresented people is exactly what we've been focused on at ImpactX. And whether or not that means our check size should be smaller, so therefore we can invest in more companies. We only have a discrete amount of money. Can we invest in more companies and more founders? Or does it mean that what we end up doing is that we end up coming even a little bit later because they don't need our money until later? So instead of being sort of a seed investor, we suddenly are Series B or C just before they go public. It's fascinating at this point, John. So even though the numbers, as we go all the way back to the beginning, I think you said 0.005%, or maybe it was just 0.05%, that is the amount of capital which is which is actually going across the board into any sort of a new venture. I would say that the question of the cost of creativity and disruption could be coming down substantially. Results being what we see in social media. The costs of participation are relatively low. So there are a lot of women and people of color who can build substantial followings, which are actually small and medium sized, and even some large scale businesses, just based on that, as opposed to having to then do some of the other things that might have had to happen in the past.
And then from an Impact X perspective, would that potentially lower your risk in terms of, hey, we're investing in companies that in some cases maybe pre or no revenue, where if I've got some AI tools working with me, I may actually have revenue, some proof of concept in the market where people are buying my service, subscription model, or buying a product, whatever it is?
ImpactX, I should be clear, ImpactX invests pretty late. We're not pre-seed investors, and we're really not even seed investors. We're Series A investors, seed extension Series A. So we spend our time after an organization has already proven that it can get to a certain point in terms of revenue. We generally are looking for at least, and these days it's much more, at least $1 million in revenue that has been proven in the previous year, and a ramp to, say, $5 million in the next 12 or so months. So we're looking at companies that are already in that space. The de-risking is that I think it de-risks mostly our search, meaning that from a investor perspective, we apply artificial intelligence tools to our screening process. We are a lean team. We're less than 6 on the investment team itself, sort of people who are actually out there sort of getting to say, this is what we want to take to investment committee. Those people have, at one point, you would have had only as much sort of aperture to see things as your own network, as your own sort of body could take in terms of how many meetings you could go to, how many calls you'd go to, how many meetups you could go to, and then what your network provided. Now we're in a situation with artificial intelligence that we can almost extend infinitely which meetings you can actually be in, which companies you can be looking at which stage that you can be looking at them before they come to the market, as opposed to when they're actually actively in market. You can start looking at them when they're nascent, when they've just registered their name and they've started to say sort of what category we're in. And then you look at their social media presence and what they're saying. It's like all of a sudden you have the opportunity to expand. So what I would say we're de-risking, and the risk mitigation strategy that we're actively pursuing at Impact X is around pipeline and making sure that we get to see even more that's out there and being able to keep pace with these new innovations that are causing more people to come into market who we otherwise would not see if we were not sort of following suit with other sort of innovative tools to help us to expand. So that, I think, is one of the most significant pieces of risk mitigation we've seen. I haven't seen any of those companies exit yet, so I don't know whether or not we've actually and whether or not their life cycle lends themselves to the same challenges that all execution challenges that all startup companies have. So haven't seen that yet.
Okay, fantastic. No, it's great the way that you guys are using just generative AI and all of the tools that is generating from it. And it seems like you look up every day, a new company has a new AI tool or new AI product that they want you to buy. So thank you for sharing that. Want to talk a little bit about the book and what led you to write the book, and is the book currently having the impact, have the impact that you thought it would?
So look, COVID is the reason this book exists, because the book was written, it was published, in 2022? The book is being written during a time when we're in lockdown, and I'm trying to launch, along with my co-founders, a new venture capital fund with a new thesis that hadn't been tried in the UK before. That's a hard thing on its own. When do you have time to actually sit down and write a book? And let me tell you, I'm married to an academic who writes books. That is not a life that I was seeking. I was never a person who said, I think there is a book in me and that book needs to come out. My on bookshelves is because someone said to me, we think that there's something that you have to say. And then I had to sort of pivot. And this is something that I think a good venture capitalist does. I have something that you might have thought about, and you've got to decide when it's time to sort of delve into that a little bit more, or to say thank you, but no thank you. But in this situation, I decided, look, I'm going to say yes to investigating this idea that there might be a book in me. I didn't have an outline. I didn't have a title. I didn't have anything. Because I hadn't intended to write a book someone wrote an unsolicited letter and an unsolicited email. I read it and I started talking to some people, and they said, well, maybe there is something. So over the course of a weekend, I decided that if I were going to say something, what would I want to say? It didn't have a name. We don't need permission. How Black business can change your world. That came much, much later. I was just, what are the sort of things, because I don't like biographies also. I didn't want to write about myself. So it's like, what are the things that I think are important to talk about right now to an audience? And given that I have some extra time, because I can't watch Netflix all day, every day, I can't sort of, bake all day, every day. I can't sort of, do push-ups all day, every day. What can I do with this time that's actually creative? And so that's what came from it. And it was a hard process for me. Writing about, let me put it this way. So many books. There are, in the UK alone, 65 million books are sold in the UK every year. There are only 61 or 62 million people in the UK. So that means and most of the books that are sold are books that are established books that are out there already by established authors. Sort of the mystery writer. I'm trying to think about who wrote Poirot, Agatha Christie. She's so well published. Her books come out every year. A new book, a new book, a new book. Then there are all the fantastic new authors who come out. J.K. Rowling and other sort of people have something that is coming out. Then you have Malcolm Gladwell, whose books, come on, you got so many books. How do you get above the noise? Because I think most books end up just being doilies. They end up being sort of a coaster for somebody's drink, right? They're sitting there, but it's not as though it's really impacting anyone's life. So how do you come up with something that you feel is worth your time? Eric's time as author, but it's worth the time of a reader? Who is going to spend their money to read this and to ingest this information and maybe have some kind of an impact on their lives, whether it entertains them for 2 minutes, upsets them for 3 days, or changes their lives? So you got to come up with all that. And I had no idea how to do any of that. And so I then started working with a sensational, but eventually I did put together a concept. And the concept, and I found an agent for this book, and it was help with a strategist. All these are Black women, quite frankly, who helped with all of this. And then we sold it in an auction with the agent to actually a Black woman who is a commissioning editor at a publisher, a big publisher, Penguin Random House here in the Trans World imprint. And so Andrea Henry bought it. So Natalie Jerome sold it. Andrea Henry bought it. Eva Simpson helped to put it all together. So I have all these Black women who are helping to put this thing together. And then I need to figure out how to write a book. The longest thing I've ever written is when I graduated from law school. And when I graduated from undergrad, there were papers that you had to write as the culmination of your thinking. So I had to figure out how to make it something that wasn't for my professor, but instead was for an audience, a public audience, and who came to it from many different places, and also then could sit on a shelf and then be used. I had an interesting story this weekend. I got a message on LinkedIn where someone said to me that they had found the book in a thrift store. And of course, thrift store means someone had or they had thrown it away. And so I said, okay, it's been in the thrift store, but at least they didn't put it in the garbage, right? They thought it might be useful enough to give to some organization. The person then said to me that they had actually lost it on the Eurostar coming from Paris to the UK. They left it on the train. They got in touch with Eurostar. Eurostar found it. They then went and spent another hour getting it back from the Eurostar, going, to wherever it was that the lost and found is. And they said that there were some aspects that had really influenced them. And I'm like, boy, that's a lot of work. And so I say that was and this really happened yesterday. I was reading a LinkedIn last night, and someone took the time to write me that note. And they said they were heading back to Atlanta and asked me when I was going to Atlanta, so I could talk to people in Atlanta about this. They wanted to they said you should have a book event in Atlanta so you can talk to Atlanta about this. And I said, that is interesting. I would not have thought, based on how this was born. I said at the very beginning, sort of in the cauldron of my ambiguity and my ambivalence, not ambiguity, but my ambivalence about writing, my inexperience and ignorance as to how to get this done, that something resulted that is interesting enough for a person it jumps out from I can only imagine what the thrift store looked like, that dusty thrift store. And it's something the person thought highly enough and maybe even treasured enough that they went to find it on the train and decided that they wanted to write me a note. It's like, wow, that's quite a privilege. So I hadn't expected that. I never expected that this would be that someone would write me a note like that. I thought my friends and family, my mother might write me a note and say, Eric, I love it, and your depiction of the family is sensational. But I hadn't expected that from a stranger who I have no idea who this is, never met, have no overlap with.
So, hey, you may be in Atlanta, Georgia sometime in the not too distant future then.
No one in Atlanta has invited me. This person said that I might think about it, right? But they haven't said, you know what? I'm going to put together at Clark Atlanta University a symposium called, We Don't Need Permission, and we want Eric Collins to be there. It's like, yeah, no one said that.
Might be on its way. We're going to put it out there. Well, thank you for sharing that. It's really interesting how the impact, if you will, no pun intended, of the writing of the book, and then with the launching and with the fun going on kind of at the same time, how that dovetails together, and you're reinforcing that same message through the work with the fun. It almost seems you have a calling in some aspect to be doing what you're doing.
And so I see behind you the Baptist Standard Hymnal. So I think I see that.
Yes.
Yeah, my mom
Yeah,
was a church musician, so I know that, and I think I
there
actually
you go.
I have a copy here. So I think we're both people who have faith in our
Definitely.
background, and so for me, it has never been a I don't know that I've ever had a time that I was not told that you were here for a purpose, that you have a reason for being. Who knows what that reason is? It's not for us to tell you what that reason is, but you and your maker, there is something there that you're supposed to do something that just you can do, or that you're supposed to do. And it's not just, again, it has nothing to do with ego. It's just that, there a lot of effort has been put into making you. And so you're supposed to be doing something. And so I do believe that there are ways in which those purposes dovetail, and the work that I've been in, and in fact, we don't need permission, and Impact X Capital Partners are part of the same mission. It is part of this idea that the world can be a very different place. And it's not as though we should leave that up to others and to let things occur, but that we have to deliberately, proactively, and unapologetically pursue the world that we think makes sense, and the world that is an equitable world. It's not for just us. It is an equitable world for everybody. And how does that actually come about? And so we don't need permission as a practical lesson in that. uh, the um, the venture capital fund, Impact X Capital Partners, is a practical application of that. Even the television show, The Moneymaker, is a practical application of that. And all of those things happen sort of at the same time. And all of those things are things also that I had to get permission from. Even though I say we don't need permission, I actually had to get permission. I am investing in my first fund. I'm investing people's money. So those are the people whose money I'm investing. And those people have put money behind us, and they do not want distraction. They do not like the excuse, well, I was taping a television show, or I was just polishing up a chapter. So your purpose, in their opinion, has to be very clearly articulated. And I learned from the questions they asked me, the demands that they made in order to say yes, and why they actually did eventually say yes, that we can allow you to sort of supplement the activity that you're doing. We expect everything to occur exactly as it's supposed to occur with no exceptions. This is not concessionary investing we're doing for Impact X, but these other things, if they can actually dovetail with, if they can actually help to accelerate and amplify, yes, you can do it. And so that's what we did. I mean, there are lots of other people. Vivian Hunt, who ran McKinsey here in the UK. There's Paul Cleal, who does all sorts of, and there's Barry Lawson. There are a bunch of people who all had to say yes, because I had dozens of LPs in that first fund, and they all had to say yes before we were able to then proceed and do any of this other sort of stuff. But in my opinion, and you hit the nail on the head, John, these things dovetail. And I do believe that we have found that they have all helped to amplify and to help us to more quickly achieve what it is that we're looking to achieve.
That's fantastic. Thank you for sharing. And that kind of leads to my next question, in terms of calculated risk. I think you maybe mentioned a number of calculated risks that you have taken here. Um, but can you make a distinction between a calculated risk and a risk, if you will, that our listeners may want to understand as they're looking to grow and scale their companies?
That's a good question. So a calculated risk versus a risk. I've never really thought about it this way, but you make it fascinating to sort of give the distinction. A calculated risk in investing is that I have gone through the diligence room of an organization. I have actually done my back channel research from people who have worked with the people who are the principals in an organization. I have seen a roadmap. I've talked to customers. I have that you have actually signed. I have done everything that I can. I've done some trend analysis. I've looked to futurists and talked to them. I've done everything that I can to determine what the risks are that are inherent in this opportunity, and that in the infusion or injection of capital from us, which could be used for any other thing, but it's going to be used with this. Actually, there's a calculated risk in terms of the return that I can actually get and that the company can actually achieve from it. That is a very deliberate approach, an analytic framework, a sort of a vetted process that takes time, energy, and effort. So that's a calculated risk. But from time to time, I make risk like this. It's like, okay, it's just like put your finger in the wind and sort of see sort of which way the wind is blowing. So a risk would be in a investing perspective that none of that actually exists. However, I kind of get a good feeling from the person with whom I'm talking. They seem to be they seem to be impressing on me that the world is changing in a fundamental way. Maybe one that I don't necessarily understand, maybe one based on my lived experience of which I have no knowledge, but based on what they're saying to me, based on this kind of logic that they present in terms of how they came to the conclusion and why that conclusion makes sense, that is for me a risk. Now, the calculation is how much I'm willing to expend and how much I'm willing to place, what kind of bet am I going to bet on black, in roulette, or am I going to, let it all ride, at the blackjack table? That's sort of that kind of a risk to a certain extent. But even then, I'm trying to mitigate the risk and make it a bit more calculated, even though I can't necessarily see the outcome that founder is seeing. So in my business, I guess our organization is much more oriented toward calculated risk. And even with that, still a huge number of the companies that we invest don't deliver in the way that we want to. And then there is the just sort of risk. There are other organizations that are highly tuned to risk. And there's some organizations, for instance, that say there's at least one organization that I know of that if you make an application to them to invest, and they're an institutional investor, they will invest a small amount of money into you no matter what, as long as you've gone through those sorts of steps. So they invest in hundreds and hundreds of companies on an annual basis. So they take a lot of risk. And the calculation for them is that of these, most of them, a huge number will just fail, but there will be some number that actually, I have actually found the right person, and I don't have to go through what Eric and his team and Impact X have to go through. I don't have to do all that. I don't have to employ all those people. I don't have to spend all that time and engage all those AI agents. All I have to do is get them to fill this in, make sure that I have the paperwork, and just let it passively exist until some future point in which it does pay off or doesn't pay off.
Right. So they're willing to live with some of the ones that are just failures, and they just figure on a pure statistical basis that they're going to find some unicorns just because they're going to look at so many deals, so many companies.
Well, because they're going
Unicorns
to
will pop up.
so many. Yeah. Because see, we would say you have to look at them. They would say you don't have to look at them. It's just I get rid of all the overhead. You don't need any of these people. All you need is a lawyer to help paper the deal and an administrator to help you make sure you have the stock certificates, and then after that, you wait for correspondence. It's an interesting way to go. It's not the way that we've chosen to go, and it's not the way most venture capitalists do. And I haven't looked at their return statistics to see sort of whether their returns are better than ours, and then the average in the market. But it could be quite compelling. I don't know.
What have you observed from CEOs of these technology companies that are looking to grow and scale their companies? And what could they do to better position themselves if they're looking for venture capital type of investment, or even if it's um, uh, private equity funding, but looking for those types of capital inflows in their company? What can they do better that you're seeing that they're doing now?
So one thing that I've seen among all, I'm just going to put this in the success category. The successful category is that successful entrepreneurs do not work alone. It is impossible. I don't think there is a company I can name. There might be a principal who stands above everyone else and has all the power and has all the financial benefit, but there's no organization that gets to be of scale by itself of which I know. And in our portfolio, that is certainly the case. It doesn't necessarily mean you have co-founders and that sort of thing, but there will always be a team which is going to deliver the best outcomes. That is a given. And so for a entrepreneur, for me, evaluating them, one of the things is, have you been able to persuade remarkable people to work with you on a remarkable idea? That's the first kind of level of investment for which I'm looking. Well, maybe the first one is for you, but that's sort of ground zero. You need to have invested in your thinking through an idea, and it's actually being able to conclude, or that small team conclude that this is the right thing to do. Then you need to be able to persuade other people to work with you. Doesn't have to be a huge number of people. Could just be one person, but one extraordinary person. Maybe it's an advisor, maybe it's a technology person, whatever it is, but that is someone who is as persuaded as to the authenticity and the efficacy of the solution as anyone else. So that's one thing that I would say I see in all sorts of organizations. And the thing that all sorts of with CEOs who are successful, and the thing that I would want those, I have to think about this a little bit, John, but what I want those people to truly appreciate is that tenacity is not enough. You know, hanging out around the rim is just not necessarily a strategy for fast growth that gets institutional backing. We are looking for the there are different risk profiles that are associated and different return expectations that are associated with different asset classes. If you were talking about a return on real estate, sort of a slow and steady increase in terms of values and, investments in things such as maintenance of your property and cleaning out your gutters and then upgrading on occasion a bathroom, those things are all sort of an expectation. And there's an expectation that growth will occur at a relatively regular rate and somewhat of a regular clip. But that is going to be a relatively small, it's going to be a percentage increase in value. What we're looking for in venture is a multiple of value, not an increase in incremental percentage, but a multiple. So times 2, times 10, times 100, and in a relatively short period of time. So that, slow and deliberate is absolutely powerful. You want to be able to do that, but you have got to also say that speed is of the essence. So understanding that as an investor with venture expectations, I need you to not only be at venture low scale, and for me to actually invest, you have to be at venture super scale. So we've got to actually see that. So if I get to see a investment where someone's saying, you know what, I can get 100% growth over the next 10 years, that's great. But I'm interested to see sort of the logic of both of those. And the question of, can you get me the metrics that I need to deliver to my clients who are my limited partners so that I can then raise more money, give them more money back and raise more money from them so I can continue doing this, then, you understand my incentives and why I need you to have somewhat aligned incentives. And so I would recommend that people in that way know their audience and know their metrics. And for venture, that's a huge and explosive growth. It's not gradual growth. And it's also not, I want to create a institution that I can let my children inherit. It's like, that's too far out for your children to inherit. I need this to exit well before your children inherit. So I have to exit at least.
That is for sure right. You may get some subsequent investors, but but yeah, we're gonna be out well before then. Well, thank you for sharing that. I just wanted to ask, what's the next hill to climb for you personally, and for the fund? Like, what's next for you guys?
So for the fund, it will always be the same to be able to consolidate more capital to invest in our thesis. And the only way to do that is by having an exemplary track record. You want to be in the top quartile, you want to be in the top decile. That's what you have to do. So it is to make sure that our performance and track record lend itself to being part of a good story. I really don't love going out into the capital raising markets, having to spin my story. It's like, oh, well, we're a fun group of people. And we have great annual general meetings and parties. Returns are kind of average. I'd rather have no parties and not have extraordinary returns. And people say, well, I want more of that sort of extraordinary return. And so that's what we're really seeking for Impact X. The next hill to climb, so that's for the fund as well as for me, because this is where my real love and passion is. And I do believe that the thing that we would love to see is some of the more of our exiting entrepreneurs. We start to see it, to be able to reinvest in the same sort of ecosystem. So one of our companies, a company named Pace, there is a one that does Pace Revenue, and they do revenue optimization in the hospitality trade. So if indeed you look a year out and you're trying to figure out how do you price your hotel rooms, if you're a hotel, if you're a hospital or something like that, how would you price them? Well, you price them based on demand and other sorts of things, but you're looking at 365 days in advance. How do you actually know that that's the right price and that you're maximizing on the Pareto optimality frontier? How do you know where you should be on that? And they help to do that. And they recently sold to Flyer, FLYR, another technology company out on the west coast of the United States. And this organization, we did a great return with them. So over a 3x return with them. So we were pleased with that. And that only took 3 or 4 years. One of the founders, who was the chief operating officer, a guy named Jason Pinto, who had been at MIT, and he started a company at MIT where he got his undergraduate degree and sold that. He'd been at Stanford where he got his master's. He got his PhD from, I think, the University of Cambridge here in the UK, all in like physics. He's one of those people, brilliant in that particular way. He decided after he had sold the stake and exited that he wanted to be part of ImpactX. He wanted to be an investor. So he came to us and said, I want to invest. That's reinvesting in the ecosystem in a particular fashion. He could go out and he also was putting money into other companies directly, but he said, I want to make sure that I put money into an institutional investor and I want to be part of that. That to me is the next hill to climb, to make sure that all of those entrepreneurs who are touched by ImpactX feel as though ImpactX added sufficient value. So value add is very, very important with people on your board like Rick Lewis or Ursula Burns or John Adabi, who was 29-year, who's now my new chair, who's now who was a 29-year M&A partner at Skadden Arps in the UK. For those people to be joined by other people and a whole nother generation who feels though this is also an accelerating engine of change and the momentum is moving faster and faster and faster, and that we want to be part of it, and we think in our generation is absolutely consequential. That, to me, is the next hill to climb. I think we're doing the right thing. But I don't know, John. I think we're doing the right thing by continuing to invest and talking about ourselves and being out there and sort of showing success. Showing success meaning returning capital. But as I said early on, I think success is all relative and sort of incremental and never ends. The attainment, they're trying to attain success. But hopefully that is what those people want to see in order to invest their very important time and resources.
Right. Thank you for sharing that. And my last question is going to be, Eric, is there thoughts of expanding outside of Britain or Europe, thoughts of coming back to this side of the pond in terms of investing in companies?
So we do have 2 offices actually in the United States. So we are in San Diego and we're also in Denver, Colorado. And in fact, our chief operating officer and the other general partner, the chief investment officer, not the chief operational officer. We don't have one of those, but the chief investment officer, Paula Groves, 25-year vet in the VC space, is in Denver, Colorado. So we've got presence. And if you look at our portfolio, we've got a number of fantastic companies. One called Laundress, who's just dealing with how do you actually deal with the second biggest asset suck in the hospitality trade, and that's sheets and pillowcases and napkins and bathrobes and that sort of thing. How do you track those sorts of things and make sure that you are most efficiently turning those things around in the laundry cycle? And laundry is something that Black people have been involved in forever, since the beginning of time. And so that question of being the evolution of laundry and laundress is fascinating. This is an Austin, Texas-based company. Then we also have Bump. Bump is for the creator economy, and this is helping creators, social media creators, to actually maximize their revenue, to be able to track exactly sort of what is the capital owed to them, then treating them like small businesses and making sure they have the other tools, including lending services and access to capital from banks and that sort of thing, on a single platform. And so that organization started by so Don Ward started Laundress, and James Jones started Bump, and Bump is a Los Angeles-based organization. All these are some of the fantastic companies that we actually see in the United States. So we actually have expanded our focus a little bit outside of Europe and the UK, but really opportunistically. And even IYANU, that's a Maryland-based entrepreneur. That's Royal Coupe. He is, fantastic. Now, those are all 3 men. We have lots of women in our portfolio, but I just gave an example off the top of my head.
Understood. Now, and that laundry company sounds kind of like the you mentioned Booker T. Washington, kind of drop your bucket where you are. what have Black folks been doing for years? It's your own laundry, but doing someone else's laundry.
Correct. That's been a business. That has been law offices, seamstresses, all that sort of stuff. We've seen an interesting seamstress, and trying to lean into some of that history. Again, it's sort of the same thing as music and entertainment, where you see a lot of Black leadership, and you also see in some of these spaces. Why should we not see disruption in these sort of spaces, which have been categories that women and people of color have been dominating for a long period of time? Let's let that be part of the evolution of those same sort of businesses.
And the beauty of it is we've been dominating it mostly from an employee standpoint, but now we're going to actually have equity and be actually owning these enterprises.
And with all of our companies, all of them provide that same sort of equity opportunity to other people. And the people, when you know how this works, that the people who are highest in the company, closest to the C-suite, receive the most equity. And those are the ones who most benefit from exits. They might not benefit the most from salary, but they benefit the most from exits. And that is where wealth is created. And there's a study here in the UK called Give Black. So that's about Black philanthropy. And what we know is that Black people, and the same thing with women, over-index, not only in terms of giving into those communities, but then also what we have found, it's not in the same study, but it's a different study, but it's a different, this is different, just qualitative research, that when you find a Black founder or a female founder or a person who has a different sort of an ability, or LGBTQ plus person, those people tend to over-index in terms of hiring and promoting people with some of the same characteristics. And those are some of the things which are necessary to build pedigree and resume in order to be able to then become the next generation of founders. So, in many ways, it is just creating, as we said before, that PayPal mafia among what we would call the Impact X. Maybe one day they'll be called the Impact X mafia, and how those people have actually helped to seed an entire generation of innovation that's changing the world and the envy of everyone.
Right. And having that capital that they own, that they can reinvest outside of their businesses, like you said, philanthropic endeavors, to kind of bring other folks along with them.
Yep. I don't care. You know what? I just want to make people the money. And I don't care what you do with it. Give it away in politics, buy a house, buy an airplane, pay off your student loans. But what we know from giving Black, Give Black, is that in fact, there's an over-indexing in terms of giving through a variety of organizations and institutions, but that donating goes generally into populations that are similarly demographic.
Well, Eric, we want to thank you for joining us today on the C-Squared Biz Growth Iron Sharpens Iron podcast. And you can find us on YouTube, Apple, LinkedIn, Spotify, and cornerstonegroup.us and other websites. So we invite you to listen, subscribe, and share. See you next time.
Thank you for listening to the C-Squared Biz Growth Iron Sharpens Iron podcast. And check us out on social media, share, and subscribe.